We'll get started in about a minute, everyone.
Hello, folks. I'd like to welcome you to Climate Resolve's Insurance 101 for Climate Activists. My name is Jonathan Parfrey. I'm the Executive Director of Climate Resolve. Just delighted that you're joining us. I wanted to also acknowledge that we did receive some funding from our own municipal utility here in Los Angeles, the LA Department of Water and Power, to have this class. And we also received funding from the group called Resilient Cities Catalyst, formerly known as 100 Resilient Cities. And we're delighted to have their support. And probably some of you know that we've had to delay this class twice now, once due to COVID. And then we, out of respect for the protests that were happening, we thought it was best to not be a distraction from those exciting events of 2 weeks ago, and decided to have the class, and we'll postpone until now. What was the motivation behind this class? One of the things I recognized when I was a commissioner at the LA Department of Water and Power was that when big utilities have to do with risk, when big companies have to do with risk, they turn to their insurance companies. And when it comes to climate change is adding a lot of risk to the way that companies, governments, utilities, and just regular old people operate in. And in this market-based economy, we do turn to insurance. So we felt that it would be helpful for us to have a much deeper understanding of how the insurance industry operates. So that is why we turned to our instructor, Wendy Nystrom, and I'll be introducing Wendy in a second. But first, I just wanted to give you a heads up about this class. This is the first of 5, and this one is an introductory course. There are not going to be guest speakers at this course, but in the 4 following courses, there will be guest speakers. And during this class, we really want you to ask questions. And the way to do it on this Zoom meeting is to put it in the chat. And I will be the moderator and reach out to Wendy when there are questions that truly do need to be answered in the course of the class. We also will have specific periods where we're going to stop and really solicit your questions. So you can put a question into the chat, you can save it for those special moments, and last but not least, Wendy has very kindly made her time available for you to reach out to her directly via her email and ask questions to her as well. I think each of you have received a slide deck via email. That'll be the very slide deck that Wendy will be using. So please use that as your resource. Well, now we're going to start. And so first we wanted to do a poll. And so I am asking, Dana, could you put that poll up for everyone to participate in? We want to know where you're dialing in from. Dialing in, that's a funny use of term. Where are you connecting from? Let us know, please. Whether it's LA County, it's Southern California outside of LA County, if it's California outside of Southern California, if you're west of the Mississippi, or you're coming from New York City, just let us know. Well, we've had a good response here. So I'd like to share the results. About half of you are calling from LA County. And then the rest largely from California with a smattering from the West and parts beyond. So a very warm welcome to all of you. Now, I would like to introduce our instructor. Wendy Nystrom graduated from Boston University, and she graduated in both geology and geochemistry. And so she began her career as an environmental scientist, working on contaminated sites, making recommendations to regulatory agencies on cleaning up those sites. And she moved to insurance, especially focusing in on pollution and environmental issues related to insurance in 2001. And she is now a subject matter expert in this field, teaching continuing education courses, speaking at conferences, and she is currently now refocusing in on sustainability and focusing on circular economy and ESG, incorporating her existing environmental insurance knowledge with the latest developments in sustainability, looking at triple bottom line fundamentals. She is also a member of the LA Metropolitan Transit Authority Sustainability Committee, and an incoming commissioner at the City of Beverly Hills Department of Public Works. Wendy, I'm turning it over to you. Thank you.
Thank you, Jonathan. Hi, everyone. It's John. Thank you so much to Climate Resolve and to Jonathan, the team, for inviting me. I've worked in environmental insurance for about 20 years and recently discovered there is this marriage between sustainability and insurance and with climate change and how it's all interacting with each other. So in one of my conversations with Jonathan, he said, would you like to teach a class on this? Because it is something important that most people don't understand how insurance works and how it's being affected every day by climate change. And that's where we are now. So today's course overview, let me share my screen real quick. So this is our class. Let me get to the advance. I'm having trouble advancing. Okay, so our course overview. Today's class is just an introduction to insurance. Next class, which is next Tuesday, we have our guest speaker. He is the head of sustainability with Zurich Insurance. And he's going to be discussing environmental regulation and the pollution exclusion. Third class is droughts and wildfires and how that's being affected with insurance as well, as we know in California. And then we move into storms, floods, surges, and we're going to tie it all together at the very end with human health and heat. So all of these things that are happening to us is going to have an end result of how it's affecting us every single day. So today's outline, brief outline of what we're doing, is just the history of insurance, the anatomy of policy, what it looks like, what limits mean, what deductibles mean, types of insurance, just some basic terminology, just so you guys can understand some of the basics of an everyday general liability policy as well as a property policy. And then we kind of go into what the general liability policy is, what a property policy is, and then the California FAIR Plan, which is sort of a last resort insurance policy that people can use in the state of California. And finally, we're going to end it with how do insurance companies stay in business? How do they make money? Because a lot of people think that these multi-billion-dollar companies should just pay the claim. So we're going to discuss a little bit about why they have so much in reserves and how they actually stay afloat. So, brief insurance history lesson here. Lloyd's of London started in 1713. It was effectively mariners were getting together talking about their risks with respect to cargo. They had ships crossing the Atlantic, ships were sinking, cargo was getting lost. So they put up their own wealth and they insured each other. And a little fun note about that is they underwrote each other's policies. So they had a big piece of paper, talked about all the risks, how much would be covered, and then they'd sign their name at the bottom. So that's actually where the term underwriter comes from, because you would sign your name under the policy. And so currently, Lloyd's of London, which is the picture you see on the right-hand side, is a huge corporation now. And some of it is actually people are still putting up their own wealth, their own personal finances. And then other ones work together in a large group under a syndicate. Now, what exactly is insurance? Very basically put, insurance is risk transfer. So what does that mean? You enter into a contract with your insurance company. With that contract, you pay them a premium. You say, I'm going to give you X amount of dollars, and I'm going to transfer my risk over to you, because if something goes wrong, I'm expecting you to pay for it. And that is exactly what the risk transfer is. So then you have to ask, what exactly is risk? What does risk mean? And the exact definition of that is the possibility or chance of loss, danger, or injury. And such, for an example, such a risk is if you live on a coastal area, you're going to have storm surges. You're in an area of higher risk for damage to your home than if you actually lived inland. If you were inland, you have a lower risk. You have a lower possibility of chance for that danger or injury. So here's your anatomy of a very basic homeowner's insurance policy. So let's just go by the numbers real quick. So named insured, that's number one, that's you. You are the insured, you are the client, you are the one giving them money to transfer that risk. The policy term is what your coverage is for. So from, usually it's 12 months, so month 1 to month 12, and all that in between is your coverage point. Sometimes you can get a policy to cover for longer, but normally you're going to see 12 months and then you just renew it every year. That's the standard form. Then for coverage type, your dwelling. So over there you see your policy limits are $200,000. Your dwelling is your house. Now, if you look underneath it and you see other structures, you're probably going to wonder, what does that mean? If you have a detached garage, that's another structure that will not be covered by your dwelling policy. So you want to make sure that you have coverage under that. Or if you have, Cheryl's she shed, that would also be considered a other structure. If anything detached is not your dwelling. So you want to make sure if you have anything else that you want coverage for, just make sure it's added in that policy. And then personal properties, what you own, your TV, your furniture, jewels have a sublimit, fine art would be sublimited, but these are for basic household things. And then your deductibles, how much you pay. So you have $100 in coverage, but your deductible is $20. You're going to pay the $20 first. They're going to pay the rest of the $80. And most importantly is your replacement value versus actual cash value. So let's use the TV example. You buy a brand new television and you've had it now for 3 years and you have a fire and you lose your TV. So you go to your insurance company, you say, I have replacement value coverage. They're going to say, great, we're going to get you a brand new TV. We're going to replace that TV. But if you go to your insurer and say that you have actual cash value, they're going to say, okay, that TV is now 3 years old. It's depreciated in value. It's no longer worth that 100% replacement value. It's now probably 80%. So you're only going to get 80% of that total value back. So it's important to know what kind of coverage you have, what limits you have to make sure you have sufficient limits, but to make sure if you want replacement, which is going to be a little bit more premium-wise, or actual cash value, just to make sure that you're okay with that, because when you do have a catastrophic event, such as a fire, you want to make sure you're whole again. Now, policy limits, touched briefly on this on the previous slide, but this is the maximum your policy will pay. So your dwelling, you see the limits there are $200,000. That's as much as it'll pay. There's no more. When you max that out, your policy is exhausted and you cannot collect any further money. Same thing with the other structure, personal property, loss of use. Loss of use means you're shut down for a little while, you can't do any business. So just pay attention to your limits, what your house is worth, because you want to make sure if you have a total loss of your house and your building is burned down, that you actually know what it would cost to rebuild that building, to make sure your limits are sufficient to cover that rebuild for modern times. Maybe you bought the policy 10 years ago. Well, the value of your home's gone up. The cost to reconstruct has gone up. So make sure you do incremental increases. And the value of your belongings are properly insured. Now, there's a fabulous story that I read about probably 2 or 3 months ago. It's a fire that happened in Malibu. It was a family that lost their dwelling structure completely, but their studio survived. They had a music studio. Now, in their dwelling, they had original scores of music that this artist had written. And he is now suing his insurance company because he was underinsured. Now, he claims that he told his broker that the value of the building was this. They did upgrades, they increased, whatever value was being put into that building, and his broker repeatedly told him he was sufficiently insured. Now, what this homeowner didn't tell him is that these original scores of music were worth $2 million. So these were not covered. The broker had no idea it was there. The insurance company had no idea it was there. So they couldn't properly provide the coverage. They couldn't underwrite to it. So without having that information, the claim was denied. So right now, the insurance broker is trying to work with their carrier to try to get that coverage, but more likely than not, they're probably going to be out of that because they didn't properly tell their carrier what the value was. So you always want to make sure good communication with your insurance broker, good communication with your underwriters, and tell them what everything is worth, or get an assessment. Sometimes we don't know what something is worth, and you can just have someone come in and take a guess or do a Google search online.
Wendy, it's Jonathan.
Yes.
We do have a question
Sure.
from the class, and they're just wondering how much documentation of one's property and the inventory of that property and the value of that inventory needs to be done beforehand. Do you need to, produce receipts or photos or appraisals, and then what do you have to do after the fact to show that that property has been damaged? How do you prove that?
So when you buy property insurance, it's usually when you buy your home. So most mortgage companies will not let you buy it without having coverage in place. So that's why in that previous slide, and also it should be an image on the PDF I gave you guys, under the named insured, which is you, the client, there's also mortgagee, that's your bank. So when you buy your house, it's going to be assessed, and that's the value. So if you own your house for a long time, you'll probably want to do incremental increases to that value. You can actually look online, like Zillow, Redfin, they can do an estimated value if you don't want to hire someone separately. Personal belongings. So that's your own estimate. If you want to bring someone in and hire them to do an assessment of your home, you can do that. But you can look at your house and say, what's my TV worth? What's my couch worth? And just kind of add that up, or what you want covered. You can say, what, if everything burns down, 50 grand will cover it. Then that's what you put. This is different for jewelry, valuable items, artwork. That will have to be appraised by a professional, and you have to provide that information to your broker so you can say, this is what it's worth, primarily because people are not always the most honest, and they'll say that they have, the $6 million TR in the house when in fact they don't. So they have to have that kind of documentation. It's always best to have photographs of things. Some people prefer video, which is very easy to do nowadays. We all have a camera on our phones. Just anything of high value, you might want to take a snap of that or a video of that to prove that it is there in your home, that you do own it. And then simultaneously after the loss, you can take a picture and they'll have a claims adjuster come. So always know that your insurance company will send an adjuster out to look at the damage. They will have their assessment, which hopefully is in line with your assessment. If you feel it is not, then you take your own photographic evidence of everything and you can contest that. You can have a discussion. More often than not, carriers like to actually have discussions with their clients rather than just shut it down. So always keep that communication open. That's the most important thing you have. I think that answered all of the questions for Jonathan.
Wendy, we have a couple more. One is a question about how people do the personal property inventory. How do you get an appraisal of that? Do you go through your broker, or do you use, there are various apps out there now as well?
Whatever you're comfortable with. So I would highly recommend contacting your broker and say, who do you know? Who do you recommend? And then again, that would be high value material. I don't think you would really need an appraiser to come in to look at your couch or your television. You can Google how much a TV costs, or Google how much your television costs you from Costco. Anything of high value, I highly recommend getting a professional in. Your broker should have that contact information, and if they don't, your carrier should. Your carrier uses those people every single day when they have a loss, so they have people on contract. They may not be able to make a recommendation for one, but you can ask for maybe a smattering of 3 to 5, and hopefully they'll be able to give you that. But there are many resources out there, and my contact information will be at the end of this. So if anyone has anything really specific, please email me, shoot me a text message, give me a call. I can help you. I can help anyone walk through it. I don't have all the answers, but I can at least find you someone who does.
Wendy, that's great. Just one last quick question. One of the things we heard about when we looked at the Woolsey fire in Malibu was that when people got their homes appraised, they didn't take into account that there had been an upgrade in building codes, which required, a little bit more sophistication when it comes to rebuilding, and they hadn't accounted for those additional costs due to changing in the building codes. Could you address that, please?
Sure. So that is an unfortunate fact. Cities and counties are always going to be upgrading codes depending on what has happened lately with respect specifically to wildfires or landslides or earth movement. They're going to have changes, and you're not always going to be aware of those changes. So that's, again, I highly recommend discussing your annual renewals with your broker. I know my parents historically would just flip the renewal, just what's the premium. They wouldn't even look at it. And when I got into the world of insurance, I asked my dad, I said, hey, let me take a look at this. And I found that his policy was actually from 1970. And he had never upgraded it. He had never used any of the new language or any of the new coverages. So with some negotiation, he actually took my advice and upgraded his policy. So it's something that we often forget. We don't even think about it. But every year, just ask your broker, has anything changed? Are there any new rules I need to know about? Any new guidelines, any codes with my property that I wouldn't be able to rebuild it with the limits that we have covered now? And they should be able to answer that for you. They may not be able to do it immediately. They might take a few days, have to do a little investigating, but they should be, they're your partner in this. You are paying them. They get a commission out of your insurance policy. So they should be able to help you out with that bit of information.
Thank you.
So on to deductibles and self-insured retention. So most people are going to be aware of what a deductible is. And that's simply the amount that you pay out of your policy. So you have a policy that covers $100 in limits. Your deductible is $20. So when you file a claim, either the insurance company is going to pay the claim in full, pay that full $100, and then say, here's an invoice for that $20 back. They're going to ask that to be resubmitted back to them. Or they'll send a check for $80 and say, we paid our $80, you have to pay your $20. So that's how the deductible works. Self-insured retention is generally saved for larger accounts, larger clients. And that's where the client, who's you, has to actually pay that self-insured retention first before the policy will even address it or kick in. So if you have a $3 million loss and your self-insured retention is $1 million, yes, your insurance company will work with you. They will talk to you, but they're not going to pay anything until you exhaust that first $1 million self-insured retention. So you want to be aware of that if you have a larger company, which makes more sense to you. And that's, again, a discussion you have with your insurance carrier, with your broker. Basically, how much involvement do you want in that claim? Some companies say, I don't want any involvement, make my SIR as small as possible, you guys handle it. Other people say, I want the say in what's going on, I want a high SIR, that means I have skin in the game, I'm as responsible as you are. So it depends on where you are and what you want out of it. And right on target for types of insurance carriers. Did we have any additional questions, Jonathan?
No, Wendy.
Nope, okay. So moving into types of insurance carriers. So most people are going to be familiar with stock insurance companies. So these are stock insurance companies. Basically, they're owned by investors who have purchased stock. It's a pretty simple definition. But types of these companies, examples are Allstate, MetLife, Prudential. So these are companies that you often see ads for. They actually, just the profits are distributed to investors. This is the more common form that we're used to seeing. The other type are mutual insurance companies. Just as common, not as common as stock, but pretty fairly common. Basically, a mutual insurance company is owned entirely by their policyholders. So if you have a policy with this company, you're considered an owner. You are involved. You are part of this company now. And examples of those are going to be Northwestern Mutual, Penn Mutual, and Mutual of Omaha. And the very first mutual insurance company ever to be created in the United States was actually started by Ben Franklin in 1752, and it still is in existence today. It covers fire hazard insurance in Pennsylvania. Now, a little tidbit that's interesting is both MetLife and Prudential that I mentioned previously. These were mutual companies. They transferred into stock companies where basically those policy owners that were owners of the company were turned into stock owners. So they just demutualized over the years and decided to go all stock rather than mutual company. Here's the more interesting one in my opinion. Captives. Now I want you to remember this particular slide, if possible, for when we talk about the fires and the floods and droughts and how insurance companies are reacting. A captive insurance company, if you look at the graph on the right-hand side, is basically wholly owned by their insureds. So larger Fortune 500 companies use these, where you have the shareholders investing in their, investing in your own business, you're investing in your own captive. The profits and the underwriting profits go right back to the shareholders again. So this is fully encapsulated. And there are over 7,000 captives in existence today in 70 different countries. So how do they do this? There's just 5 easy steps, and all you have to do is you have to determine your structure. There are several structures out there, and if you're interested, we can talk about that by simply Googling the different types of structures. You have to conduct a feasibility study to see if your company is capable of it. You have to hire a captive manager. You absolutely want somebody who knows what they're doing with this. You don't want to self-manage this. You select your domicile. Again, there are 70 countries offering this. So you can pretty much set up a captive anywhere you feel like. And then you prepare and submit your application. They want to make sure that you have the funds necessary and the capital necessary to run your own insurance company. But I want to bring this up and have it stick in your head when we talk about insurance coverage later on, how insurance is changing, how carriers are changing, and what some of the resolutions might be. It might be a situation where a group gets together and self-insures as a captive. Stranger things have happened. It's just something that, anything's possible if you want to do it. Now, the types of insurance that we're primarily going to talk about throughout the courses. You have your primary insurance. This is what you see with your homeowners, your general liability. It is basically your first layer of insurance. It's the risk transfer between the insured, that's you, and the insurance company. So this is your risk transfer. It's just like, I am going to give you money. You are going to take on my insurance risk. Now, reinsurance is something a little bit different. This is not between the insurance company and the insured or the client. It's between 2 insurance companies. So a perfect example of that is, I knew someone, if everyone remembers Woodstock 99, I knew someone that offered the insurance on that. And they were very excited that they landed that deal because it was a lot of premium. And his boss said to him, get as much reinsurance as possible. I have a bad feeling about this festival. Now, as it turned out, the Woodstock Festival, there was tremendous amount of property damage, quite a bit of bodily injury, contamination. There was garbage everywhere that had to be cleaned up. It was a huge financial loss. So they turned to their insurance company. We have property damage, we have bodily injury, we have all of these things, hundreds of millions of dollars in losses. And thank God this guy decided to get reinsurance. So basically all it is an insurance company says, I have this huge risk that I'm not too terribly comfortable with right now. So I'm going to sell a portion of it to this other insurance company, pay them a premium, and they're going to take that risk. So it's basically risk transfer among 2 different insurance companies. Now of that, you're going to see below you have facultative reinsurance and treaty. All this means is facultative reinsurance, each case is a one-on-one scenario. Let me look at every single account you have, and then I'll decide if I want to reinsure you. Treaty insurance means you have a contract in place. They basically set up the parameters of a little box. In that box, they say anything that fits in here, we'll cover it. We don't want to look at it. As long as you fit our parameters, just send it over. We'll, pay us the premium. We're good. We'll take it on. So those are just the two separate kinds. Now, this is going to be the recurring theme through all 5 classes, is what is liability? In short, do no harm. But it is every kind of legal obligation, responsibility, or duty that individuals have towards each other and to society. So, an example of that is you own a store, and in front of your store, the sidewalk or the pavement leading to your front door is broken. Someone approaches it, falls, breaks their leg. You're the one liable. It doesn't mean you're negligent, doesn't mean you're malicious. It just means you're responsible for that pavement. You're responsible for everything to be safe. So that person was harmed. You are the one responsible. You are hence therefore liable. So that's all it really means, but you're going to see this term throughout all 5 classes of who's liable for what, who's responsible for what. So going into some very, very common policy definitions. These are definitions you're going to see over and over and over again. So basically, loss is the basis of every single claim you're going to have. It's from pure risk, so you're going to have what's typically what happened and what went wrong. So your loss could be you fell. That's actually bodily injury. I'm sorry. Your loss could be there was damage to something. Something went wrong, so you make your claim. Bodily injury is illness and disease, including physical. Now, one thing to make you aware of is it can also mean mental anguish. So someone could be upset. They could be not necessarily physically hurt, but mentally hurt. So that is something to pay attention to when you do have your insurance in place. But in short, bodily injury is usually referred to as slip, trip, and fall. And your peril, that's just a cause of loss. So loss being the basis of your claim. And a peril is, anything is a fire, a windstorm, collision, storm surge, anything that actually causes the damage. So when someone says, what's your peril in the state of California, we're primarily fire. Fire is our primary peril here. If you're working if you have an agricultural policy, your peril is going to be drought. That's going to be the primary thing that you worry about. And then last but not least is property damage. That is damage to or the destruction of public or private property. So that's caused by a third party. So you can't damage your own property. You're not going to be able to make a claim for that. It has to be done by somebody else. So that would be your property damage. Most policies you see are just going to say, what's your BIPD? And all they're saying to you is, what's your bodily injury? What's your property damage? So those are just the 2 main terminologies that we're going to be paying attention to.
Wendy, it's Jonathan.
Yes.
I have a question. So you had the previous slide on liability. Would you say that climate change is increasing the liability, or is that static? And what's increasing instead are the next slide of perils and losses and bodily injuries and property damage.
Yes, go ahead. I'm sorry.
No, please.
No, I was just going to say, so going back, so liability is do no harm. We have no control over what's happening right now. We're trying to fix it. We're trying to address climate change by lowering greenhouse gases, but that's not something you can directly point at one individual or one company and say, you did this. What is increasing is our perils. Our losses are obviously increasing. I have some data in the other classes where I'm going to talk about the amount of damage we've had from fire, the amount of damage we've had from storm surges, but peril is drastically increasing. So thinking about, our fire class, which is class 3, we are experiencing massive amounts of drought. And that's just from the dryness and the heat, and then longer growing seasons in the summertime. So our grasses then dry out and it becomes kindling for these fires. That's an increased peril. In addition to that, we have people moving out of the cities into more woodland areas. That's called urban sprawl. That's a huge peril for us because now people are in places where there weren't any people, again with the dry scrub, the dry brush, and they're doing things with chainsaws, they're driving trucks, so sparks ignite this dry brush, and that's where you get your wildfires from. Another peril is the electrical utility lines. We all know that they're not in great shape. They need to be addressed. That would be a liability for a utility company to fix that. So that's where your liability goes in, because you can actually point to one thing and say, you did harm, you did not fix this. So that's what the utility companies are working on right now, saying they have to address it. They know it, they're working as fast as they can, but there's quite a bit of line out there, and there's only so much you can do in a short period of time.
Could one argue that fossil fuel companies are contributing to the liability, or could one say that insurance companies that invest in insurance and invest in fossil fuel companies or provide coverage to fossil fuel companies are in some way contributing to these liabilities?
It's a very difficult question to answer, because that gets into a lot of litigation of who's responsible, as again, who's liable. So yes, we know that fossil fuel companies are emitting greenhouse gases, but it's also something that they've been doing it for a couple hundred years. So they're going to claim that this is their status quo, this is their everyday business. Simultaneously, insurance carriers that still provide coverage or invest in these fossil fuel companies, are they contributing to it directly? Not necessarily. So that becomes very litigious. And it's something I simply cannot answer in this time frame, or even with like a lot of data and research, because there will definitely be litigation in the future. This is something that will happen, but on what scale, I'm not too sure right now.
Thanks.
Sure. Any additional questions?
Not at this time.
Okay. So next one, the insured, that's you. Person or organization that buys the insurance, you are the insured. The insurer is the company. So always remember, you are the insured, you are the one that paid for your premium. The insurer is your company. They are the ones that are insuring you, they're providing the coverage. So as long as you are upfront with what you need covered, how much it's going to, how much coverage you need, what your losses may be. And again, these are negotiations you have with your broker, you fill out an application. As long as all of that information is as honest and informative as possible, and always remember, more information is better. A lot of people don't like to give too much information, but coming from a previous underwriter, it doesn't hurt you. It actually helps you, because it gives us a better idea of what your company does, what you're doing, or with a dwelling, how much you have, what's in your home. If you live in Malibu on the beach, is that $200,000 limit sufficient? Probably not. So let's have a conversation. Let's find out, what's the assessed stat? Go to Zillow.com. You always want to make sure communication's open. And then the last definition is really something that is particular to pollution. It's your potentially responsible party. So a potentially responsible party, you have your individual owner, operator, transporter. They're basically, when you take something, let's say, to a landfill, let's say you're a transporter and you were hired to haul some dirt off to a landfill, no problem. 20 years later, you find out that landfill is contaminated and is probably due to some of the dirt you dropped off there. So even though you had no direct exposure, you didn't directly dig it up and you didn't own the land it came from, you're a potential responsible party because you brought it there. And you could potentially be brought into a lawsuit, and the EPA will recognize anyone and everyone involved, because there's something called a bill of lading. That's everyone that comes on the property and drops off material. They get checked off. Who are you? Where'd you come from? How much did you, deliver? Great. So there's a record of that. And we have had, when I worked in claims, we had people that dropped off old paint from the 1950s that were being brought into lawsuits. And some of these companies didn't even exist anymore. So always make sure that, if you're in that business of any contaminated material, any hauling, any transporting, always know what you're bringing there. Always know that, you have that kind of coverage in place. Again, that kind of coverage we're talking about in class 2, but if anyone has anything specific, just reach out to me. I can walk you through that. And we actually are in perfect timing for a break that we scheduled to do our breakout class that we're going to start at 4:15. So that worked out quite well.
Before we go there, there are a couple of questions, and I was hoping that Dana, you might turn on the ability for questions to be asked by Arlene Hopkins. Arlene, did you want to ask your question at this time?
Yes, well, actually, that was why I gave it to you directly, Jonathan. So I've actually taken an interest in the whole issue of the commons and how so many of these environmental circumstances like air and water and forests and ecosystems and habitat and even agriculture are part of what is sometimes referred to as the commons. So when a company essentially externalizes costs by damaging common pool resources, how would that be addressed from an insurance point of view? Or maybe insurance and law have not yet caught up with that interpretation. So that was the gist of my question.
So I think you're correct. I don't think they're quite caught up with that yet because it is something very new.
Mm-hmm.
And again, it has to go with who's liable, who's responsible, who caused the harm. And then, you know, what was the peril? What was the damage? You know, is the damage something tangible? So when people say that we have air contamination or greenhouse gases, how do you qualify that? How do you quantify it? How do you put a number on that? So it's an excellent question, and it's something that absolutely should be addressed and must be addressed. But again, it's going to be, unfortunately, something probably triggered by litigation of who's responsible, who's liable, how do we fix it, how do we address it, how do you monetize it, how do you put a number on it saying, you know, if you continue to do X, you will have damages of Y, and those damages may or may not be insurable. It might be something the company has to, you know, bear that cost.
So
rather than, I'm sorry?
Follow up, if I may then. So there are academics and scientists who are attempting to do that. I'm sure Jonathan and others on this call are familiar with that emerging literature. But so, for example, there is something called Ecological Economics,
Mm-hmm.
where they do attempt to do that. But part of the issue is not only how to assess value and to assess loss, but it's also how to assess liability, because there are multiple players, each
Yes.
and all of whom have caused this accumulated damage over time. So do you have any thoughts on that?
Very complicated question. I'm afraid I can't answer that right now. I mean, you are absolutely right. It is something over a very large period of time. I mean, we're not talking in the last 10 years. We're talking, you know, hundreds. I mean, if you really want to go back, the 1880s is really when, you know, things started up with the Industrial Revolution. And then, of course, you know, when I was working, I was helping out river keepers in New York when I lived there.
Mm-hmm.
And there were basically petroleum was leaking into the East River from the Newtown Creek, small creek coming down through the East River. And it was estimated 11 million gallons was soaked in the soils, and it was just dribbling out. And river keepers kept trying to sue these petroleum companies that had consolidated over the years from the multiples that went all over the place to just a few.
Mm-hmm.
And the state of New York back in the 1950s sent a letter saying, we know you contaminated the land. We know it's leaking to the East River. Don't worry about it. You're okay. There is I have seen it. And so when I was helping them out, they said, you know, can you look at this? And, you know, what can we do? And I said, just keep filing lawsuits, I guess, but they do have a get out of jail free card.
Mm-hmm.
And every time there's a lawsuit filed, they pull it out and say, but we have this. So that's the history you're dealing with. We need new rules basically going forward.
Mm-hmm.
We need people to stop doing what they're doing.
Right.
That would be great. That's a long road ahead of us. We're getting there. But we just need people to start paying attention that it's not just a small thing that we're looking at. It's actually much, you know, and the next classes, I basically talk about the chain reaction of everything and how it's ultimately going to, you know, lead to human health.
Mm-hmm.
So excellent question. And we need these people to, you know, try to quantify it, you know, try to wrap their hands around it and say, this is what we need fixed. This is what we need addressed. And we're just not there. But fabulous question. Thank you.
Thank you.
Thank you, Arlene. Thank you, Wendy. Wendy, we have a question from a participant who has the username PWalk, and I am hoping to unmute you. Dana, could you unmute P. Walk, please?
Hi, yeah, I don't have a question, but there are environmental liability policies that companies use to respond in case of environmental liabilities.
Yes, those are the contractor's pollution liability and also the pollution legal liability policies. And those are specific to contamination on or off your own property that either you caused doing your own, doing work as a contractor, or that is existing on your property and impacts someone else's, or someone else's contaminated land impacted yours. So it's not related to climate change. It's primarily with respect to underground storage tanks, chemical manufacturing, releases, or spills.
Exactly. So I think I made that comment when I heard someone ask about, what some of the oil companies policies that they may have. And so they purchase those sorts of policies as
Yes.
a matter of practice.
And only responds if there's a release or a spill.
Mm-hmm.
So when we're talking about with climate change, we're talking more like greenhouse gas effects, climate, heat index increasing, something a little different, but that's definitely, you are well ahead onto class 2. You're going to love class 2 because that's all we're talking about. We have case studies from Love Canal and Times Beach, have an environmental professional that's also speaking. So that, we're pretty much going into all of those coverages next Tuesday.
Thank you, Wendy. The class is now going to take a break until 4:25. That's a 6-minute break. And then when we reconvene, you will be in a breakout group. And Wendy, what are they going to be talking about in their breakout group? Very briefly.
I provided the questions in the Excel spreadsheet that I sent you guys. Hope you have it.
The questions are, what is better, a deductible or an SIR? And the second question is, why is reinsurance purchased?
And I guess from here, everyone goes into a breakout room and you can just discuss. And if anyone has specific questions afterwards, come back and we can discuss that before moving into the main policy page.
We're going to take a few-minute break. And when you come back from the break, we're going to do the breakout. Thank you. You have 5 minutes, 5-minute break. Wendy, hi, I think you're still muted. We had a question in our subgroup and we thought you're the expert. You might be able to answer us. And this comes from Dan Zales. And he wanted to know, who are some of the groups that take advantage of SIR? Are they
very large corporations? So Fortune 500 companies, usually people that might have a large pollution exposure. Usually SIRs are with a pollution account. And basically who someone wants what they call skin in the game. So if you have a high SIR, you have a lot of control over how that claim happens, where you can say, I'm hiring an attorney, you know, I have $1 million SIR, I'm going to hire my own attorney, and usually the insurance carrier will work with you. Simultaneously, if there's a claim to be made, they'll try to settle it below that SIR, so they don't even involve the insurance company. They'll just say, we'll handle it. We don't want it to impact our policy. We'll just pay that SIR amount or below and just resolve it.
Thank you, Wendy.
Sure.
We did have a question from Glenn Dake, which is, does the insurance broker for a homeowner's insurance have a duty to the homeowner and to represent the homeowner to the insurance company, or are they an agent of the company? And when you're applying for insurance, what's that relationship?
Depends on the carrier. So let's say an example would be State Farm. State Farm usually has their own agents. So when you talk to an agent of State Farm, they're representing the insurance company, State Farm. But let's say you are working with AIG. You're going to have not an AIG agent, you're going to have an agent that works for Aon or Marsh or Gallagher. And they're going to be, you know, working with the insurance carrier, but they're representing you and they work for you. They're supposed to be the advocate for the insured or the client. So as long as you are providing them sufficient information, again, they're going to ask you a ton of questions about your property. And if you can't figure it out immediately, you work with them to try to figure it out. But if you simply say, that's none of your business, that's my property, not yours, you don't need to know this, then they can't properly represent you. And that's where it kind of gets gray of who's representing who. So they are representing you. They have a duty to properly, you know, get you proper coverage. But simultaneously, you have a duty to them. You have to give them the proper information so they can help you. So it is a symbiotic relationship. And if you're not comfortable with your broker or you guys just don't like each other, you can ask to be moved to somebody else or find someone else, because technically you are paying them. They, you know, they work for you, and it's, you know, a partnership.
We had a question from Gabriel. Gabriel, you're unmuted.
Oh, great. Yeah, in our group, we just had a question, which is, why would any individual choose an SIR over a deductible? Or is that just simply not an option for individuals?
Generally not an option for individuals unless you're very high net worth and you want control over your policy. It's primarily for Fortune 500 companies. They want to be in control of their claims. They want say in who gets settled, who doesn't, what goes, you know, to court, if at all. If it's a high SIR, they'll sometimes just, you know, settle the claim beneath that SIR, send the info to the insurance company to say, hey, I paid $100,000 out of my $250,000. So as far as you're concerned, my $250,000 SIR is now $150,000. They will, you know, mark that towards their SIR. But it's primarily for control. If somebody wants say in their policy and how the claim is handled, that's usually a larger company. I myself, if, you know, I have a property damage claim, I don't really want to be involved in the negotiations. I want my insurance carrier just to kind of handle it and resolve it, and hopefully, you know, we're all on the same page. I don't want to, you know, muddy up those waters personally.
Wendy, have you heard of municipalities using SIR?
Absolutely. So municipalities would be public entities. There is a special policy called a public entity insurance, and it's usually extremely encompassing of general liability, property, directors and officers. It's usually just a bunch of coverages together. And a lot of them will start with a $250,000 SIR. They won't even have a primary layer. It'll be an excess policy with an SIR. And that way they can handle these smaller usually called nuisance claims. So in a city, if someone trips on the sidewalk and says, oh, I got hurt, I want $10,000, sometimes they'll just pay it to make the claimant go away because the litigation costs will be far worse.
Thank you.
Sure.
All right, I think we're ready to resume.
Okay, so we are into the main policies, commercial general liability and property insurance. Let me advance. So, oops, sorry. So commercial general liability, or CGL, is basically third-party coverage. So you're not
We need your
covering
slides, Wendy.
I'm sorry?
We need your slides on the screen, please.
Oh, did it not?
It didn't load, at least for me.
What happened? Did I stop sharing? Let me, oh yeah. For some reason, my screen stopped sharing. So. Okay, well, thank you, Jonathan. Do not know how that happened. So commercial general liability, CGL, is basically third-party coverage for your bodily injury, so the slip, trip, and fall, and property damage. So this is third-party property. This is not your property. This is somebody else's property gets damaged while at your place. So someone parks their car in your driveway, hailstorm happens, or actually hailstorm's a terrible example. Someone throws a rock at their car and shatters their window. It's on your property, it's third party. It would probably, depending on your relationship with your neighbor, but they could make the claim on your CGL. And there's also something called product liability that you probably don't need to really know about, but if you have a product that you make, so let's say you manufacture honey, that's what you do. You're a honey company. That's a product that you make, you sell it to somebody, and if somebody gets sick or ill, that would be product coverage. That would be the product liability coverage that someone got sick with your product. On to property. So this is what we're really going to be focusing on. This is for dwellings, and there are many, many coverages for property. So without going into a huge amount of detail, you're going to see this on the PDF I gave you. But HO1 is specifically, it's called named peril coverage. So you see all the named perils. Remember we discussed what perils were before, is like, you know, wind, fire, storm, surge. So the named perils are all listed below. So if you have a loss and it's a result of lightning, fire, smoke, etc., if it's there, you're covered. If it's not there, you are not covered. Now HO2 is again broad form named peril, but you can see that there are more. So when at the very bottom of volcanic eruption, on HO2 you have falling objects, damage from the weight of snow, ice, or sleet, water damage from plumbing, heating, air conditioning overflow, damage from electrical current, and pipe freezing. So it's just a broader form of H1. So they're very similar. It's just HO2 gives you a little bit more. Now, moving into HO3, this is your special form. This is what they refer to as an open peril. Now, this can be a little tricky. So before we had named peril, as long as you had one of those things happen, you had coverage. This is sort of the opposite. This is you're covered as long as it's not excluded. So always, 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 always review your exclusions. They're usually pretty far back in the policy. Your homeowners, your property policy, just ask for a copy of it. Sometimes they'll just give you that front page called the declarations page. Ask for the whole body, including exclusions and endorsements, because these things will get added on. So in HO3, usually the common exclusions are earth movement, earthquake. These are different things. We all know earthquake in Southern California, shake of the earth, you know, a little scary. Earth movement means landslide. Anytime there's slippage. And in Southern California, we have a lot of unconsolidated materials, so houses do slide, but it's not an earthquake. It's earth movement, and it's usually excluded. So you want to be very careful about that. Sinkholes, very popular thing in Florida, they're excluded. Mud flows, water damage, flood, sewer backup. It does happen. It happened to my family in the mid-'80s in Michigan. All of these things, you want to make sure what your exclusions say. And if you feel that you have that risk, call up and see if you can get some kind of endorsement back on. It might cost you more in premium, but if you think you have that risk, it's more important to have that coverage than not. Now, HO4 is just a renter's policy. It's covering your personal belongings. It's not covering the dwelling. It's not covering the foundation. It's not covering anything else other than your personal belongings. And then HO5, that's your broadest form. Oddly enough, it's not the most popular, but it is the broadest. It's your most comprehensive, and it is going to basically cover as much as possible in, everything that's not, it's basically like the open peril, but check your exclusions. Things might be excluded on there, but what HO5 covers as well is personal belongings. So the other ones, the special form, that's just dwelling. That's just your structure. That's just your house. This is actually including your personal belongings. So you want to see, it's going to cost more, but it is comprehensive. HO6 is just for condos. It's dwelling. It's not going to cover the structure itself. There's usually a separate policy for that that's required by your condo association. So this is just your personal belongings. Your personal property and anything from the studs in. So any artwork you have or any fixtures you have, studs in is the coverage. And then HO7, very simply put, it's mobile home manufactured homes. So if you have a mobile home, that's your only option. Again, HO6, if you have a condo, that's your only option. The other 5 depends on the coverage you want and how broad you want. Sorry, with the exception of renters. Renters is its own. But basically, look at your exclusions, look at what type of property you have to make that decision.
Wendy?
Yes.
In our survey of the Woolsey fire, we learned that there were a lot of unpermitted structures that got converted into housing dwellings. So converted garages, converted sheds. And then there was even like gypsy wagons that people lived in. Could you explain, like typically that would be an HO7, so they wouldn't be covered by most homeowner insurances?
So if you had a trailer on your property and you did not buy, mobile home coverage, your regular homeowner's policy is not going to cover it. Again, with those detached buildings, that shed or the converted detached garage, that's going to be considered other structure. And if it's illegal, then that would be a way for the insurance carrier to deny coverage, because what they're intending to cover is a detached garage. There's only supposed to be a car in there. There's only supposed to be, a couple of items for storage, not someone's belongings, not someone's personal property. So again, you have to, it's a symbiotic relationship with your broker of providing information, telling them what's on site, telling them what the coverage you need. So if you say, hey, I converted my garage into an apartment, you want to make sure it's legal. That's a whole other issue to deal with. But you can say, I do have a separate structure that we rent out, so it's not a garage. And then you can discuss the types of coverages that you could add on to that dwelling policy.
Just to beat a dead horse here, I just want to be absolutely sure that I got this right. So let's say converted a garage into a dwelling unit, but I can only get coverage because it's what's legally permitted is for that to be a garage. And so if it burns down, I could only get the money to rebuild the garage, not the dwelling unit.
True, because it was an illegal structure. You want to make sure you do things legally. Hope that answers it. I know it's not a great answer, but you do have to be within the confines of the law.
Yeah, thank you very much.
Sure. So going on, so we just discussed dwellings, so personal property coverage, and now we're talking about commercial or all risks. So all risks is a very interesting term. A lot of people are kind of pulling away from it. We have the commercial all risks that goes into, what it means. Again, you always want to make sure you look at your exclusions. So even though it says everything's covered, it's really not. Look at your exclusions. It's most likely going to, exclude earthquake, earth movement, pipe freezing, ice, sleet, just the little things like that. So make sure you read your exclusions. And then people are also simultaneously using the words open peril and special peril. And if you read all of these definitions, they kind of repeat themselves over and over again. So even though they're all saying the same things, I cannot stress enough, read your exclusions. So if someone says you have an all risk policy, you have an open peril policy, you have a special risk, special perils policy, great, read your exclusions. You want to make sure you understand what is not covered, because it's saying everything's covered except these things. So please make sure you read that, because that is what causes most problems in a claims issue, is you think everything's covered and it's not. So again, you know, your relationship that you have with your carriers and your brokers is very, very important. Now we go into the California FAIR Plan. Now, the FAIR Plan is a very interesting entity that was created in 1968. In short, it's basic property and coverage as a last resort. It was created where people could not get insurance anywhere else in the marketplace. And to my knowledge, you do have to present 3 denied quotes, or 3 denied options from an insurance carrier saying that no one will cover me. So your California, you know, Fair Access to Insurance Requirements Plan is a last resort. It's not a state agency, but it kind of works like one. So one thing to pay very, very close attention to for your dwelling or residential policy, your limits are 1.5 million. Yes, that's a ton of money. Most places that would be great, but we know that California, we have very high real estate value here. So 1.5 million limits in insurance is not very much to replace your home. You can purchase excess coverage over that, so you have your primary layer and the excess just stacks right on top of it like a Lego brick, but that can be expensive. And you want to make sure that, you know, your limits are, you know, reasonable for rebuilding. It's a named peril coverage. So it's not open, it's named, and it's limited to fire, lightning, internal explosion, and smoke. That is it. You can purchase more for, you know, additional premium underneath, but those additional ones, windstorm, hail, explosion, highly unlikely for explosion, riot, civil commotion, aircraft, highly unlikely you're gonna have an aircraft hit you, vehicles and volcanic eruption, very unlikely you're gonna have a volcano. But please note, your coverage is primarily going to be fire, lightning, internal explosion, and smoke. That's it. And you only get 1.5 million in limits. And then they're going to look at it as a partial loss or total loss. So is your house completely destroyed, or is it only partially? So if they determine only part of the house is destroyed, you're only going to get partial coverage. Simultaneously, if you have the complete house gets destroyed, that's considered a total loss. And to one thing to please pay attention to at the bottom, it's actual cash value coverage. So it's not replacement. This is, they determine the fair value of your home prior to the incident, and that's what you get. It may not be what it costs to rebuild. So please pay attention to that if you have, you know, if you're going to be using the FAIR Plan, or if that's your only option, you might want to look into that excess coverage. And then for commercial policies, part of the FAIR Plan, you know, this is for 5 or more habitational units, so apartment buildings, retail, mercantile, office buildings. Policy limits, 4.5 million, of which 3 million is for structures and 1.5 for all other coverages. So when you have a building that is going to get damaged or destroyed by fire, will 4.5 million be enough to rebuild it? Probably not. We all know the values out here are very high. So excess is an option, but you also want to see what your coverage are, and it is named peril again. So the named perils, you're going to have fire, lightning, explosion. Very limiting. So it's not a great plan, but it's kind of all we have right now, unless if you think about the captives. If, you know, a group got together, you know, it's not a terrible idea. I don't know how feasible it is, but that's where I want everybody to start thinking about is, okay, we have these increased perils with fires, with droughts, you know, storm surges, hurricanes. I saw someone checked in from Ypsilanti, Michigan, my hometown. Tornadoes are happening. They had a huge storm last week. So these are increased perils that are all interconnected with this climate change issue we're having. And if we can't get the proper coverage out of carriers, maybe there's something out there where a captive could be created. and shareholders are involved, and everybody, you know, profits and loses at the same time. Just something to think about. I'm not aware of anything existing right now, but it's just something that you can play with in the back of your head. Maybe to think of, you know, future options. And again, the commercial policy is actual cash value, not replacement. So you want to, you know, pay attention to those. And then business owners policy, sometimes you hear people call it a BOP, and people love to throw the BOP word around. It's basically business owners is going to cover your structure, your contents, and liability. So liability meaning someone gets hurt on your property. And the policy limits are $2 million. That's not a whole lot. If your building gets burned down, you know, you have liability, you have, you know, personal objects that need to be replaced. So of that $2 million, $1 million is for your contents. And then the business liability, if someone gets hurt, it's $300,000 for each occurrence and $600,000 aggregate. What does that mean? So $300 per occurrence means I fall down, I get hurt, I break a leg, you know, cost $300,000 to fix me up. And someone else a week later, same thing happens. They break their leg. It costs another $300,000 to fix them up. You're done. You have now aggregated $600,000. There is no more. Your policy may have a $2 million limit, but for that kind of loss, $600,000 is all you get. So if a third person falls down, breaks their legs, and has another $300,000 to get them fixed up and out of the hospital, that's out of pocket. So you want to be very careful with things like that. And sometimes those are negotiable. Sometimes you can buy higher premium, or rather higher limits, or you can do excess. And excess markets, you know, again, they stack on like a Lego block. Everything that's covered by the primary gets covered by the excess. And again, it's a named peril, so it's going to have a few more things listed than your other policies. So you've got fire, lightning, explosion, windstorm, hail, smoke. The list goes on, but you want to make sure that you read that list and see if there's anything in there that you might have exposure to that's not listed. And be very clear with that and see what your options are. Again, this is limiting. Fair plan is very limiting, so you may not be able to add things, but you can always ask. And I highly recommend asking. If you don't ask, you'll never know. And then
Wendy,
our final, yes.
This again is just covered by the term of the policy. So someone could trip and break their leg on December 31st, and then another person trip and break their leg on January 1st, and it would be two different policies.
Two different policies, yes. As long as your start date and end date is December 31st and January 1st, but that 12-month period, yeah, so it's not aggregated forever. It just means during your one policy period, as long as you renew, you're fine. And the last topic before we go into a discussion of Q&A that hopefully we're going to get to between 5 and 5:30 is how do insurance companies make money? So one of the things that got me interested in the marriage between sustainability or climate change and insurance is I had a lot of people approach me at conferences that I was attending saying, why don't carriers just cover it? They have billions of dollars, just pay the claim, just pay it, just do it. And my first question was that started this course was, what are we covering? So you want climate change covered. What is climate change? And that's when we discussed what perils were, what loss was. And the next classes we'll go over pollution, fire, flood, etc. But then everyone says, well, just pay it. And I said, well, if insurance companies pay every claim, they will go out of business. And then there's no insurance company at all. And they say, well, they have billions of dollars. That's legally required to be held in reserves. So think about a large company. Let's use Zurich Insurance. So they have thousands of policies out there. Some policies have a limit of 1 million. Some policies have a limit of 40 million or more. They have to have in their reserve bank enough money to cover if everything goes to hell at once. So if all of these policies get triggered, they have to have enough in the bank to pay people out. And that's when insurance companies go bankrupt. There was a company called Quanta back in the mid-2000s. They did environmental insurance. And they very good underwriters. These guys did nothing wrong. They just wrote like gangbusters, wrote a lot of policies. And it's just everything went wrong at once for these guys. They had claim after claim after claim, and disaster happened. And they just couldn't pay their bills. They didn't have enough in reserve to cover everything, and they ended up going out of business. And all that happened within 2 years, 2 or 3. And lesson learned, you can't write everything you want at once. It looks great on paper. You made all this premium, but you got to be able to have enough in the bank if everything goes wrong. And that's just a requirement you have. So with revenue, you charge your premium in exchange for insurance, and then you can reinvest that. So in the stock market, it was great in the 80s. People just made money hand over fist. Not so much the case anymore with very volatile markets, so we're not making as much as they used to. And so then how is profit calculated? So you have a little equation here. Profit equals the premiums, subtracting out your claims losses, expenses, so the expenses, keeping the lights on, paying your underwriter, paying your claims person, and then the return on those premiums. So when we talked about fossil fuels, that was one example I have right here. Publicity, it's bad publicity to be covering these guys right now. So these guys are divesting. More important, well, not more importantly, but simultaneously with, the bad publicity, fossil fuels are not great to be investing in right now. It's high risk. People get killed in mines. Mines collapse. There's terrible bodily injury involved. Property damage is terrible. There's a huge pollution condition with that. I called acid mine drainage. So companies were actually pulling back saying, this doesn't look so healthy anymore to us. We don't really want to be involved in this. So that's another reason that carriers are divesting. Chubb made a great announcement last year. They said we are no longer covering mines. Other companies are following suit. It's not a great investment. It's not the right thing to do. And I think more and more companies that are focusing on their ESG, which is, the environmental social governance filings, you want to do the right thing now. And I think that's very important for people to think about as we kind of broaden our horizons, to think as a bigger picture and kind of dilate what we're working in, and the fact that human life is kind of important. We like being here. Maybe we focus on that and not so much what's destroying that. So it also is, doing the right thing. And then we have, your loss ratios and your combined ratios. So perfect example of a loss ratio. You make $1, you pull in $1 in premium, and your client has a slip, trip, and fall, and it costs them 50 cents. So you have a 50% loss ratio. You made 50 cents. So perfect example is when people talk about workman's compensation. If you have workers that get hurt all the time, their loss ratio or their comp mod is going to be above or below 1. If it's above 1, that means, if it's 1.25, for every premium dollar you pulled in, you're spending $1.25. That's losing money. Companies don't stay in business very long who do that. If you pull in, $1 for your premium and your losses are only 85 cents, you've made money. You get to stay in business. That's your profit. So my next slide is a fantastic little diagram, or rather chart, of your loss ratios. So if you look to the far right, where it says select P&C lines, direct incurred loss ratio, I'd like you to look at some of those numbers. So 2018, where it says 154.68, so that's 154.68 loss ratio. So every dollar made, it's basically $1.54, 54 cents lost. So losing money, very high loss ratios. It goes even up to 300.53 in the year 2018 for capital insurance. I'm not entirely sure capital insurance is around anymore. If someone knows otherwise, please speak up now. But if you have a very high loss ratio, you're not making enough money to pay your claims, and you will eventually go out of business. So that's what these companies have to do. And again, investing in stocks back in the 80s, they made a lot of money. Stock market was great. We're not in that same situation anymore. Stock market's way too volatile. People are not investing as much as they used to. It is primarily now expenses, loss ratios, how much premium is being brought in versus how much is being paid out. So going forward in these next few classes, I want you to think about that and think about, why insurance companies act the way they do. And again, I'm more than happy to have personal conversations on anything specific that you have, you want to discuss. That is what they have to do to keep afloat. And if they go out of business, then everybody loses. So we have to find that happy balance. And as you can see, from 2018 to 2017 to 2016, It's going up dramatically. 2016, all of those lines, they were all under 100. They're all in the 40s and 50s. And now we're going up to over 100, well over 100 in some cases. So we now have a problem with this increased peril due to climate change, due to greenhouse gases, caused by pollution. Everything is this chain reaction hitting each other, ultimately ending up in human health and environment being damaged. That is where we end today's class. We're going to have discussions, Q&A. Next class is going to be June 23rd. That's our pollution class. We're going to have 2 case studies, Love Canal and Times Beach. Our guest speaker will be Ben Harper. He's the head of sustainability at Zurich North America. And talking about the pollution exclusion. That is an exclusion on your commercial general liability and your property. Anything that is a pollutant is not covered. And that's where, I'm forgetting the lovely woman's name, but she brought up the environmental policies for pollution legal liability and contractors pollution. We'll touch on that briefly. But yes, now let's lead into our discussions. And that's my personal info. This is my direct email, my direct phone number. So please write it down and shoot me a message if you have anything specific. Or if you just want to talk. I love talking about this stuff. It's sad. I love insurance. So Jonathan, if you wanted to kick off discussions.
I thank you so much, Wendy, and I hope people take advantage of your contact information and reach out to you. And once again, I wanted to thank the Resilient Cities Catalyst and LA DWP for their support to make this course happen. Dana, why don't we just open up the airwaves, the mutes, unmute everyone, and let's see if we can't have a conversation. There are 42 participants, but let's see if it works that people can ask questions on their own at this time.
I've just allowed everyone the option to unmute themselves if they would like to ask any questions.
Thank you.
This is Arlene. I have a question, please. Can you talk about crop insurance for agricultural operations?
Sure. It's not my background. I don't know a whole lot about crop insurance specifically, but I know the primary peril for that is drought for crop loss. It is getting hit massively by the droughts that we're having, the higher heat, crops are failing. Did you have a specific question about crop insurance? I mean, it's a problem, but it is not my specialty, unfortunately.
Okay, I don't have a specific question now.
Okay.
And Wendy, on health insurance, we've been looking mostly at property insurance, but if you were to teach a course in health insurance, how would that change?
So actually the 5th and final class does talk about human health and the heat index, and we have a specialist from Deloitte that will be speaking. And she has a ton of data that she's collected from FOIA requests from healthcare industries about how increased heat is affecting people. So you have to think about, it's not just hot outside, it's affecting workers. So work comp claims are going up, people are getting sick more frequently, asthma's getting affected, the inability to breathe. There's even, she said they found some data about COVID being related. I don't know the specifics on that, but we'll see if she's able to share it, because some things are still, proprietary. But health insurance is greatly being affected. People are getting sick more frequently. Asthma is definitely up from our air quality. We have seen air quality get a little better with things shutting down to COVID, but it's not the resolution we need. There's a lot to be said. I mean, I'm not a health insurance is very, very different than CGL or property or even pollution, very different worlds. So not my expertise, but we will be tying everything in class 5 to that. So everything will kind of funnel into that ultimate effect. Any other questions?
Hi, this is Dan. I have a question. Is there any historical precedent for, the idea of liability from like a polluter or some other group impinging on the common good. I know that's sort of kind of where things are going now with the climate change, and we all live in the common environment, share our environment. But I'm wondering, is there any any cases or any precedent for that?
That's a very good question. So pollution coverage is generally for contamination from a site. So storage tank leaks, but it's never once covered smokestacks belching smoke, because that's just business as usual. It's what we do. It's what we've always done. I have been privy to some conversations where they're saying it is a release, and this, because definition of a pollution condition, which we'll talk about next class, is the release, escape, seepage, migration of a pollutant. This is technically that. So there is some chatter out there, nothing official, that they might try to tie in greenhouse gases, methane, any kind of smokestack release into that pollution definition. Now, I'm not saying the carriers are going to jump all over that and be happy to do it, but there is discussions within groups talking specifically about this. So it's an excellent question. We'll have to see what happens. I'm not part of those conversations. I just know the right people to talk to. So I get some of that insider information. But that one caught me off guard when that conversation came up, because, my background being a pollution underwriter, we never considered it. It was just never discussed. It's like, well, of course, it's smokestacks. It happens. It's been happening for 200 years. Now, all of a sudden, people are saying, wait a minute, we need to address this. This is wrong. This should not be happening. So we'll see what happens. Very, very good question, topic to bring up.
Thank you.
Yeah, this is Jen Bravo. I was thinking along the same lines, and I was thinking basically like as government agencies and municipalities are going to begin to realize the costs of addressing the impacts of climate change, they are going to be looking to get industry to pay for some of that, because the costs are going to be extraordinary over time, right? And they're layered. And so how can we hold oil and gas industry and other polluting industries in this sort of broader definition of what pollution might mean accountable or liable for paying for either some of the cleanup, if that means carbon sequestration, whatever that means, or paying for care that needs to happen because of the impacts, the human health and ecosystem impacts of climate change.
I would love for all of those things to happen, and I love the carbon sequestration to actually happen as a result of maybe a settlement. That would be great. But again, these all have to be ferreted out with the carriers, the actual insured, let's say it's ExxonMobil or so-and-so, and municipalities. They all have to get involved and say, okay, how are we going to handle this? Because if we just come down on somebody like a hammer and say, you're going to pay this, it'll just explode in litigation. People be tied up in the courts. Who has the most money to pay their lawyers is usually what happens. So I would love them to come together in a mutually respectful relationship and try to sort that out. And if that's figuring out how to suck carbon out of the atmosphere or drive it into concrete, that'd be great. And I think Bryn had a question. You're on mute right now.
Dude, thanks. I'm going to take a moment to describe the sort of situation, if I may, and then I'll get to my question. So in the world of community engagement and sort of trying to get community-driven investments, there's a little bit of a trend of trying to get community-based organizations, sort of groups that are out in the community to be doing some of that work. So to get some government contracts to be doing community engagement. And a barrier to being able to do that is the government agencies are very risk averse and want them to be covering very large liability coverages, plans. And these sort of small CBOs aren't able to fit that in their annual budgets. So I guess I'm wondering if there's any modified liability plans out there that are more like for a specific project or something, so they're not sort of taking on that annual.
There are separate policies for project specific or event insurance, depending on what is happening. I'd have to think about that. I mean, you wouldn't need it for an annual basis because it's not something that's going to happen 12 months out of the year. So that's something very curious. I'd have to think about that. I haven't run across that before. Anyone else have a question?
Oh, Wendy, we may have come to the end of our first class. So
All right.
please accept our heartfelt thanks. This was a
Thank
great.
you, guys. I look forward to class 2 on pollution, where we're basically going to talk about heavy contamination and how government agencies responded to the creation of CERCLA and RECRA and all those great acronyms that I will go into detail on, and where we're going from there. So thank you, guys. I appreciate it.
Thank you.
Thanks.
Thank you.
Thank you.
Thank you.
Bye, Rachel.